Um, Hello, everyone. Good morning, good evening, good afternoon to everyone joining us from different time zones. I am Manjeet. I'll be your host for today's session titled What If Your Underwriting Misses the Next $10 Million Risk? This webinar is brought to you by TX Minds, division of Testing Experts, and we are excited to welcome an audience of insurance leaders, underwriters, and technology decision makers who are navigating one of the most urgent shifts in our industry that's moving from traditional rule-based underwriting towards AI-enabled real-time risk decisioning. Before we start, a few housekeeping notes. The session will run for around 60 minutes, including a 15-minute live Q&A at the end. You can post your questions in the Q&A panel on your screen. And this session is being recorded, and we'll share the recording link with all of you post this event. Now, I would like to introduce today's speakers, Mr. Jon Mayo, Senior Vice President and Head of Insurance Practice at TX Minds, and Mr. Rakesh Pal, Vice President and Insurance Vertical Head at TX Minds. They'll walk us through how insurers are using AI, real-time CAT intelligence, and smart valuations to reduce underwriting leakage, accelerate decisions, and strengthen competitive advantage. Additionally, a special reveal awaits you at the end of today's session, so stay tuned. And now I'll hand it over to Jon. Jon, please take it over. Thank you.
Thank you, Manjeet. Appreciate the introduction, and welcome to everyone on the call. Obviously, underwriting is a hugely important process in the insurance workflow. Really, it's kind of the beginning process that kicks off everything else that happens thereafter. And it also affects dramatically the financials of your organizations. And I'm assuming that on this call, we're going to have people who already have one or more underwriting workflows in place and underwriting different types of risk in different locations, different geographies. So we'll try to cover things somewhat generically so it's applicable to everyone, but the specifics around the technology would apply everywhere. Let's start at the beginning and let's talk a little bit about what the challenges are around underwriting and more specifically automating and making underwriting more efficient. There are a number of challenges that the underwriting departments face. One is primarily business focused, which is the desire for speed, efficiency, time, in the sense that we are in a competitive market. And when agents and brokers submit quotes, if it's new business, or even in the cases of renewals, the time that it takes to rate and quote and then eventually bind a policy is a competitive factor. And companies that do it better than others typically do better financially in terms of net written premium. The counterbalance to that is accuracy. And speed without accuracy is meaningless and financially disastrous. So we have to keep in mind that our goal here, while we want to improve efficiency, we want to improve responsiveness from a competitive standpoint, whether you're dealing direct to consumer, direct to insureds, or whether you're dealing with a independent agency base or a captive agency base, the accuracy is extremely important. And the accuracy is what drives the end financials, the risk profile, the financial risk profile that you're taking. It can affect your own internal risk as well as your reinsurance risk. So ultimately, what we're looking at doing is how can we take existing underwriting workflows and improve them, both from an efficiency standpoint as well as from an accuracy standpoint. So in the beginning, the introduction, Manjeet called out a few themes that we're going to see repeated throughout this session we have today. And they revolve primarily around data, number one. And of course, we've always had data. But the issue is, how do we get access to that data more quickly? How do we get access to the right data for the risk that we're underwriting, for the insured that we're evaluating that is appropriate for this particular underwriting exercise. Then in addition to that is, how do we go about increasing the efficiency so that the decisions that come from evaluating that data happen faster and accurately? And there's a lot of factors that go into determining how we are going to manage underwriting in a automated insurance workflow or an AI-driven world. Okay. We've got a lot of complications that are continuing to evolve in evaluating property risk. Obviously, one of them is the climate risk. We're talking about catastrophic events, and we're talking about high levels of financial risk for certain geographies, certain locations, certain types of property, and also from certain types of perils. So having access to that type of data is extremely important. And being able to model those catastrophic events, be able to make a predictive analysis based on past behavior, as well as future climate models, is extremely important. The other big component is from evaluating the value of a property from a financial standpoint. The construction costs, material costs have all changed so dramatically over the past 5 years. Inflation, supply chain issues, increased competition, tariffs, all of these factors go into determining how much is it going to cost to make a client whole in the event of a property claim. And that data is extremely important when you're evaluating a underwriting scenario. So access to construction cost information, material information, as well as information about inspections, about the quality of a building, the age of, for instance, a roof, the type of siding materials, all of those that go into underwriting risk. And I realize that most of you on this call already have some of this or all of this available to you. The issue is, how accurate is it? How recent is this information? And how quickly can you access it and use it in real-time decision making? So let's go on to the next slide and we'll talk more about this. Okay. So when you're looking at an underwriting process, the goals of increasing efficiency allow us to eliminate or at least reduce some of the standard problems all of us have heard about, complaints that we've heard within the organization as well as outside of the organization. Customer friction is a big one, and customer friction could be the insured directly in the case of direct to consumer, or in the case of a insured waiting on an agent to get back to them with a with a quote or with a policy. And the idea here is to speed up that process, create an efficient quote to bind process, and have it be highly accurate. Okay? Also, while the issue of human touch points within the underwriting process is a big one, and ultimately there's a balance. And the goal would be to try to increase efficiency and automation to the point where there's a high comfort level with a fully automated straight through system. However, it takes time to get there. And in some cases you won't, because there might be certain risks or certain dollar values where you have to have a person take a look at it. But ultimately the goal is to increase efficiencies and to have humans in the loop where absolutely necessary and important. And that frees the people up, the underwriting staff, to work on those more complex cases and get those cases adjudicated faster. Now, all of this ties in to the ratios. It ties into how you manage your risk, which can affect your internal operations as well as your perception within the reinsurance market and your ability to place risk globally. So ultimately, all of these issues are factors that we take into account when we are architecting and designing a more efficient underwriting platform, utilizing data and technology to drive more precise decision making faster. Now, the kind of the man in the corner that we always have to take a look out for is compliance and regulatory issues. And we want to make sure that these decisions that we're making in an automated fashion pass regulatory muster. And obviously, there's a variety of different regulatory challenges that all underwriting cases face. From the standpoint of making sure we're compliant with the rate tables and the filings, if appropriate, with the departments of insurance, as well as rules against discrimination or favoritism. And so the trick there is to make sure that, number one, that we build that into the underwriting process, but secondly, that all of the underwriting decisions that are made are well documented and auditable. So if there ever is a question about how we arrived at a particular outcome, we can go back and see the decision-making tree, follow the logic, and look at the data that was used to drive those decisions so that we can, in effect, be fully transparent in terms of how those decisions were reached and that they were done in a legally compliant way. Let's go on to the next slide, please. So ultimately, our goal is to make underwriting smarter. And by making underwriting smarter, we make it more precise, more accurate, and we also make it more personalized because of the access to data. And keep in mind, this data can exist within your organization already. It may not be easily accessible, but most insurance companies have an incredible amount of data, both on policies, policy holders, historical data, risk data, claims data, all kinds of data that are within the organization that would be helpful during the underwriting process. The issue isn't necessarily the data exists and you can get to it. The issue is, how do you find it and access it more quickly, and then access the information that you need for a particular underwriting decision that needs to be made? And that's where the automation comes in, and AI can certainly help with that. Okay. That gives us the ability to be able to price things more dynamically. We can price things based on more real-time data in an accelerated way with increased precision. And that leads to better business outcomes for both the carrier as well as the insured themselves. So it's all about speed, it's all about accuracy, about personalization, and the ultimate goal is to arrive at the right underwriting decision, the right pricing for the right level of risk. Go ahead to the next slide, please. Okay. So ultimately, we've talked about data, and we'll talk about AI as well, but let's drill down a little bit more into data and what types of data are out there, and more importantly, how do we provide that data as part of a overall solution, particularly around property underwriting. Okay. Now, ultimately, I mentioned on the earlier slide, we talked a fair bit about internal data. Okay. And the internal data is great. Not all companies have equal amounts of internal data, but there is a lot of publicly available data. Data that is either available at no cost, or data that you can subscribe to from various data brokers, data services. And this data can feed into the decision-making logic that we're describing and discussing in our automated workflow, or our increasingly automated workflow. One thing also to keep in mind is that a lot of the things that we're discussing, the large carriers, the tier ones, are already doing. And it's cost a fair bit to do it, because if you go back in time, 3 years ago, 5 years ago, the data and analytics tools, the BI tools that were on the market were very expensive. The subscription fees were expensive, and the cost to implement these BI tool platforms were also expensive. And so the prevalence of AI and the prevalence of increased access to real-time data, to a large extent, has democratized a lot of this and lowered the cost of entry, the barrier of entry. So the idea is we can take existing insurance workflows around underwriting and augment them by adding capabilities to those workflows without having to replace them altogether. Bolt things on the front, RPA, take RPA-enabled decision-making and augment that with agentic AI decision making, and all of that is driven by some of the topics we talked about earlier. But ultimately, it comes down to data. So ultimately, and it also depends on the type of property and the type of risk that you're underwriting. But we have things like IoT. IoT went from being novel to being mainstream. We have all kinds of new data about hazard risk, catastrophic risk. The aerial imaging has gotten extremely good. We're all familiar with drones. The satellite imagery has gotten tremendously better. The types of information we can get from aerial imaging in terms of some of the subsurface, the geographic and the geologic sites that some of these properties are built on has gotten much better. The engineering has gotten much better. And so ultimately, we can take a lot of this imaging, and then by applying AI and machine learning on top of it, we can extract the relevant information that we need in order to augment the decision making that goes in to underwriting these policy requests that we're receiving. So taking all of these data sources and all of the different types of data, structured data, unstructured data, and being able to import that and extract the relevant information and then apply it to an underwriting decision is what we call a solution framework for precision underwriting. So at this point, I'd like to hand it over to Rakesh, and we can start digging into the technology side of the house and how do we actually enable some of these themes that I've been discussing for the past few minutes. So over to you, Rakesh.
Thanks, Jon. Hello all. So I think great insight has been shared by Jon already. I mean, this is a burning need for many of the insurer who are into property line of business, who are who are facing extreme challenges in respect of doing a right risk analysis, avoiding any risk leakage during the underwriting, to the contextual pricing, so that underwriting becomes more profitable at any point of time, even during the CAD that is happening more frequently nowadays than previous. They should not think about leaving any of their business zone, any of their business, any of the postal code, not to write those kind of property line of business or the property coverages anymore, right? So I think while data is basically creates the entire backbone of it, but it is very essential that this data needs to be utilized, right? The data needs to be well orchestrated. That data needs to be feed to a system, a sort of integrated workflow, which can be used by the underwriter, and eventually that can actually enable them to get into the next level of underwriting, precise underwriting, profitable underwriting, contextual pricing when it comes to the property line of business. So I'll touch upon a couple of levers there. Might be I hope many of you there, you might have already started thinking about those, but then let's see how it resonates with you well, right? So when it comes to truly transform the property underwriting, we basically need to go beyond just a digitization. We need intelligence at the core of the process, with the precision property underwriting framework, which can also be integrated with an intelligent underwriting workbench solution. So what this is, right? I mean, I know I've used a lot of jargon. So let's break this entire solution framework into multiple layers so that you can understand what we are proposing, how we are actually thinking, the way this underwriting, property underwriting can actually be more optimized. So at the foundation is the data, which we talked a lot. I think Jon has touched upon all the different data types, the data elements, which has been considered previously, the new type of data that we need to consider to do the precise underwriting. So that's the data layer, right? We need to integrate all these different diverse sources, right? In the satellite, drone imagery, IoT device, telemetry, public records, weather history, so on and so forth, right? Third-party property data sets and many things into this solution framework. And here the AI role starts as well. So what it can do, right? It basically needs to automatically clean, classify, and validate this entire set of data to ensure that underwriter or this solution framework start with that trusted and a structured inputs. Then let's move into the next layer, right? Which is basically the AI-driven risk modeling layer. Here is where machine learning models come into the play. These models are well trained on millions of past claims, geographic features, and building characteristics. They help us to understand not only the probability of losses, but the expected severity and the velocity of all these different risks, which are actually changing over time. We also need to incorporate advanced peril specific model, which is very different than the traditional model. This peril specific model needs to be tuned to your wildfire, hail, water intrusion, roof degradation, and many of such parameters. These are continuously refined, and this needs to be refined through your feedback loops. These models enable highly granular risk segmentation and letting underwriters differentiate even between the two houses on the same street. Now comes the next layer, which is the optimization layer, which is again that needs to be powered by AI, or you can say powered by more agentic AI. This is where AI models simulates pricing scenarios, analyze historical quote conversion data, and recommend optimal pricing for each of the risk profile. We know we have heard a lot about personalization, contextualization in pricing, but let me tell you that that is not a marketing term anymore. I think it should be actuarially justified and backed by data and tailored for every single property that insurers they're writing. In parallel, AI-assisted triaging identifies low-risk submission that can go through STP or straight-through processing as well, which is very, very important. While the high risk and the borderline cases are intelligently flagged for the human review, but this straight-through processing will actually help to get your low risk underwriting go more faster, more efficient, and with the right pricing, which is help your underwriters to focus more on where they need to focus to analyze the high risk entities. And the final component is the underwriting experience layer. Think of this as a kind of decision cockpit, might be not just a dashboard. Here, AI explain its risk recommendations, presents the property imagery. It basically transcribes what exactly been considered for this kind of recommendation. It integrates all the different data sources. It integrates to your actuarial sheet, right? It integrates the different recommendation based on the analysis of the risk that has been done, right? Or not only the risk, eventually the analysis of the the pricing of the remediation that needs to be done, right? And then it can suggest actually if there is any endorsement or coverage limit that also needs to be tailored for a certain type of risk. And what's the impact of it? See, the impact is the reduced underwriting leakage. That's the foremost thing. More accurate premium to risk alignment, obviously, and increase STP rates, and critically, a return to profitability in challenging geographies where traditional methods just can't keep up anymore. This is the future of underwriting, which needs to be AI powered, data enriched, and outcome driven as well. Moving next, let's understand what is the value that you can reap. If you're really up for bringing these changes, bringing this whole shift into your underwriting model when it comes to the property level underwriting. Obviously it comes with a cost, obviously it comes with technology, but then this needs to be vetted well with the ROI that can be measured and that can be realized as a end state outcome. So what does all this translate in terms of the business outcome is that is something I'm going to touch upon right now. With AI-powered risk scoring, the STP rates, the straight-through processing rate of low-risk property submission can actually be increased to 30 to 50%. Yes, what you heard is correct. It can be actually increased to 30 to 50%. That means more policies bound in less time with minimal underwriting touch. And not only does this drive the operational efficiency, but it enhances the customer experiences dramatically because not every customer needs to be waited for a longer duration just because their risk is not so critical and they're expecting a very quick turnover of their quotes go to bind and bind issue as well. We are also seeing a 10 to 15% of reduction in underwriting leakage with this augmented underwriting solution platform, by eliminating manual data entry errors, inconsistent inspection, and subjective risk assessment, which was so far that's how it is. We are This solution will be tightening the process and reducing any premium drift. Underwriters are no longer drowning in paperwork or spending hours spending time on low risk evaluation. Instead, they can actually focus on edge cases and strategic accounts, leading for better moral and high value decision making. And so, as the profitability improves, as pricing becomes truly aligned with the risk, we are no longer subsidizing any high risk properties with a low risk premium. And importantly, all of this done in a transparent, explainable, and auditable way, which is of utmost important, which means you are better prepared for any compliance, regulatory views, and even ESG reporting, which are inevitable. So smarter underwriting is not about just making things faster or just making things profitable. It needs to be fairer, leaner, and more resilient as well. Let me touch upon a real world scenario. Like as we are talking as TX insurance practice, we are talking to different customers, who are facing this kind of challenges, who are constantly burning with their the underwriting loss ratios, the profitability, the margins when it comes to the property underwriting, on the huge losses they incur during the cat. I think we understood some of those challenges, and while we are doing all the solution consulting and advisory to them, this is what recently we could see this actually gets into a real time play. We are actually talking to a regional carrier operating in a wildfire prone areas of the West Coast, and their traditional underwriting relied heavily on schedule inspection and outdated valuation models for commercial and the personal properties. The result? Low STP rates, delayed court cycles, underwriting losses, high operational cost, and persistently high loss ratios. Here is what we actually advise as a part of our consulting engagement with them. So one, we told them that they need to integrate high resolution aerial imagery and use of AI based image analysis to score the condition of the roof, evaluating factors like visible damages, tree overhang, presence of solar panel, vegetation risk zones, and etc. etc. This actually removed the need of any manual inspection almost in 40% of the cases, the way they were doing traditionally. Two, we advise them to introduce a AI-powered data prefill and risk scoring models. This uses all those structured and unstructured aerial images, third-party data, siloed data to dynamically score each property, considering all this data into integrity and on the likelihood of any of the perils like fire, damage, water leakage, or reconstruction difficulty. Three, we also advise to personalize the pricing algorithm, add factors in the pricing to accommodate the very minute factors or the parameters about the risk profile, occurrence chances, claim history, and risk management planning. We all know that all this pricing algorithm, they basically they takes care of all these different aspects. But with new age of technology introduction to do better risk analysis, to make very precise risk evaluation, to understand the possibility of chances, while every risk profile is very different, I think it's time we should look at a different or a more finer pricing algorithm as well, so that your pricing of all the different policies become more personalized and more contextual. Five, we told them to create an intelligent rule for low risk properties so that it automatically cleared for binding through a more straight-through processing path driven by threshold value parameters and without even touch of a human underwriter. Use agentic AI to flag borderline properties with dynamic recommendation. For example, flag for, let's say, mitigation discount if any defensible space around the property is verified. And the impact was really dramatic. The carrier saw almost close to 25% of increase in their straight-through processing for low-risk homes, which meant a faster quote turnaround, lesser underwriting fatigue, and improved broker satisfaction. More importantly, by aligning premiums more precisely with actual risk and improving the granularity of the segmentation, their loss ratio dropped almost around 10 to 12% over last quarter. And here is the kicker. This was not just a technology upgrade. We made them understand, we made them realize that it was a business model shift from a static, delayed risk assessment to a more real-time, predictive, and adaptive underwriting. This example proves that smarter underwriting is not just a theory. It's not just like it's on paper, but it's happening and it is profitable. It is creating the business value to the different insurers. So let's transform this underwriting together. I think we touched upon the cases, we touched upon the different factors, we touched upon the data, we touched upon how this can be solved, we touched upon a real-time scenario. Let's conclude how we can transform it together, right? And at any point of time you feel to talking to us, we are more than happy to come and talk to you, help you to fine tune your the entire underwriting model, how this needs to be shifted, and obviously that needs to be contextual to your line of businesses, to your operations, and to your need. But as we wrap today's sessions, here is a clear message, right? So property underwriting doesn't have to be a high risk and low margin affair anymore. With the right combination of data, AI, and workflow orchestration, we now have the power to assess risk more precisely, price it more fairly, and process it more efficiently. At TX Minds, we are partnering with many such forward-thinking insurers to operationalize smarter underwriting through solution consulting, agentic AI solutions framework, proven accelerator, which is tailored to the property line of business. So if you're looking to act on what we have discussed today so far, here are few strategic recommendations we leave you with, and we are more than happy to hear back from you as well. First, the prioritization of data quality and completeness at the property level. Let's invest in satellite imagery, geospatial data, IoT, and historical claims to enable real-time visibility, better CAT modeling, and context-aware underwriting. We all have thousands, millions, trillions of data. It's time we need to start wisely using that data, understand the gaps in the data, bring the data, make it more integrated so that your analysis, your become more smarter and driven by the AI models. The second, embed AI into the triaging and risk scoring. AI cannot be an optional technology to you anymore. You need to adopt it, obviously, with all consciousness, with all fairness. Use ML models to dynamically segment risk, automate low complexity cases, and let human underwriter focus where they can actually add more value. Built out strategic straight-through processing for low-risk properties. Again, a very important aspect. You need to streamline intake, pre-fill, and decisioning to reduce quote to bind time for low-risk coverages and enhance customer experience as well. We also need to shift from one-time risk assessment to a continuous risk intelligence. It cannot be a static risk assessment anymore. We need to incorporate feedback loops from claims, inspections, external events to evolve the models and stay resilient to the climate volatility and continuously evolving demographics around us. And last but not the least, don't just digitize, but orchestrate this intelligently. Tie your data, models, and workflow together on an intelligent platform with integrated ecosystem that can learn, adapt, scales as with your growth. Let's transform the property underwriting together with precision, personalization, and the speed. With that, I'd like to end my part of the pitch. Thank you for all your attendance. I'll hand over the mic to Manjeet. Manjeet.
Thank you, John and Rakesh. It's been a very insightful session so far. We'll now move into the Q&A portion of today's session. For all the attendees, if you have not already posted, please feel free to submit your questions using the Q&A panel on your screen, and we'll try to cover as many as we can. In the meantime, Rakesh and John, I have a few questions with me already. So maybe I'll shoot the first one. So Rakesh, you spoke about AI-driven valuations. How are insurers balancing speed with regulatory compliance when automating those decisions?
Sorry, I was speaking on it. Great question, Manjit. I think that's a critical balance that we all need to do, and that's where the AI introduction needs to be very careful, needs to be well vetted in terms of the transparency, accuracy, and make sure no regulatory penalty get imposed, and you are sort of you're leveraging the value of it at a right forum in a right context. So I think insurers are embedding the explainable AI nowadays, this principle into their valuation models. This means every automated decisions, whether it's a coverage limit suggestion or a risk rejection or at a pricing, it comes with a documented rationale that can go for a regulatory audit as well. In addition, Manjit, I think, and I usually say this in most of the forums, see, AI cannot replace the human, right? So eventually you need a human in the loop, and many of the carriers, they are basically doing that. So while they are bringing more and more AI models, they are bringing more automated recommendation decision making through the agentic AI, but still there is a human in the loop in the place for the edge cases, so that complex and borderline risk get reviewed manually. The key is to use let's say to drive this 80% of your underwriting, which can be straight through, right, which is almost zero to minimal intervention is needed, but while ensuring the transparency, fairness, and auditability for the rest, and make sure that is well vetted by a human brain who is kind of experienced in that particular job.
Sure. Thank you, Rakesh.
Yeah.
Second one I have is around cat events. As cat events are becoming more frequent and less predictable, how are real-time models helping insurers respond more proactively?
I'll go ahead and take that one if you don't mind.
Sure.
So obviously, one of the biggest risks that large portfolio insurers, property insurers take is catastrophic risk. And that takes a number of different forms. We throw the term cat around quite a bit, but there's a big difference between hurricanes and wildfires and earthquakes. And ultimately, it comes down to managing that risk. And the predictability of it is one thing. So you can look at forecasting models, you can look at historical events, you can look at GIS systems with CAT modeling, and try to figure out where you think the greatest risks reside. For instance, Florida, everybody thinks of hurricanes, but another big issue in Florida is sinkholes. And that affects residential and commercial property, and so that involves geologic surveys. Then you have wildfire risk. Well, wildfire risk is somewhat seasonal, but it's also driven by human decisions. And so monitoring all of that real time is a big part of it. However, another big part of it is financial engineering in terms of how do you mitigate the risk that your company is taking? How much risk do you want to take on yourself? And how much do you want to sell into the reinsurance market? So I think having all of this insurance underwriting data, and the data not only about how you arrived at a particular premium, but the data about the property itself and the insured itself is very useful when you start getting into reinsurance pools and being able to package and place this risk. So there's two different components here. There is the data that is decisioning for the purposes of determining the rating and the pricing for a particular risk, given its proximity to a area that is subject to catastrophic risk. And then the second part of it is how can you use that same data to help you determine the concentration of risk you want to take in a certain area and how best to package that risk for the reinsurance market.
Sure. Thank you, John. I've got another one. So how do you see underwriting evolving over the next 2 to 3 years, especially with the growing use of AI and live risk signals?
So I'll take it up, Manjeet. So yeah, I mean, underwriting is moving from a kind of document-based, very traditional, retrospect, manual, subjective process to more real-time, more signal-based, more analytics-driven, more recommendation-driven, and analyzed, based on the analysis of integrated data set, right? So I think it becomes more a sort of more proactive version than a sort of reactive, I mean, looking at it reactively, we'll see a shift towards a continuous underwriting. I think where the risk signals, like any of the updated imagery, claims behavior, sense any sensor activity, that automatically triggers the policy adjustment or alerts. So we know there is a day two transaction we talk about. We talk about the policy servicing. We know there are policy audits, right? That's going on. But I think era is coming when some of these activities, some of these different transactions on the policies, that is going to be more continuous. And believe me, Manjeet, it's a win-win for both insurer and both for the customer. While insurer, they can price policies at a right time with a type of risk where they are into the type of risk mitigation arrangement that has been done, right? Any of this risk, as since it is continuously evolved. At the same time, the insured, they don't feel well, they are more mindful about avoiding this particular risk, managing that particular risk. They're basically might be shifting the risk profile from to a lower level. They shouldn't wait for a year before this actually gets into the renewal, and this needs to be re-evaluated, right? So I think AI is also kind of getting democratized in decision making. It is the assistant underwriters or even distribution partners will be empowered with data driven tools to to quote or pre-underwrite confidentiality as well, so which is eventually will improve the speed and consistency. So I think in next 2 to 3 years, underwriting or policy underwriting, that's going to take a a sort of a dimensional shift, I would say.
And
Sure.
then a couple other things from a system standpoint, from an application standpoint. I think we'll see over the next few years the package underwriting solutions, thinking of underwriting workbenches and underwriting application packages that are commercially available. I think we'll see them start to include more of the themes we've been discussing this whole session, particularly AI. The upside there is that you get that in a package solution as part of your license or your transaction fee. The downside is that they get to pick what AI technology they use, and they get to control that to some extent. And one of the big themes that I hear over and over again when we start talking about AI and agentic AI in particular is the proprietary nature of underwriting, that carriers are very sensitive about not wanting their underwriting algorithms becoming public knowledge. And there's I'm sure everybody knows there's a lot of buzz in the AI world about copyright and the lack of respect for property rights, for intellectual property when in AI engines, and AI engines ingesting material that is copyrighted and making it available without the copyright holder having control over that or being remunerated for it. And so part of that also applies to insurance. And I want to be clear that just because we're talking about AI and agentic AI, that is not the same as exposing your data and exposing your decision making outside of your organization. Okay? There are plenty of AI solutions in which the LLMs and the data and all of the logic resides inside your applications, inside your firewall, and it is not publicly available. So I want to be clear about that. And then secondly, I also want to be clear, it's not an all or nothing decision. You don't have to completely replace your existing underwriting system, your existing underwriting workflow. plenty of customers we're working with are incrementally augmenting their existing platforms at fairly low cost and generating efficiencies. For instance, one popular area is on making sure that all of the submissions from brokers are in good order before they're sent through for underwriting process. And what that entails is making sure that all of the data elements that are needed from an insured about a risk that are required to underwrite that policy are present before the underwriting process starts. And we've even automated that review so that we take ingest information provided by the broker, and the broker can send it over in, different times through different formats. It can come via email, it can come over text messaging, come anyway, and we can extract that data from those different data formats, whether they're structured, unstructured data, and we'll slowly build in that data XML that defines all of the data elements we needed to underwrite the policy. And then if we're missing something, the system will automatically notify the broker what we're missing. So from that standpoint, we'll be in really good shape to be able to help speed up that process and make sure that everything that's needed to make the underwriting decision is present from the very beginning. And so all of that can be augmented to an existing workflow. And I mentioned earlier RPA. A lot of companies have already implemented RPA, robotic process automation, in their underwriting workflows and other workflows. And agentic AI is a natural extension of that existing investment in RPA. So we can extend the capabilities and functionality of your existing workflow system without having to replace it altogether. So I think it's important to call that out explicitly. I think it was inferred during the presentation, but I don't think we said that explicitly. So I don't want people thinking that it's an all or nothing. You can take what you have and make it better.
Sure. Thank you, Rakesh and Jon. So we have a question from Eddie in the chat box, and he asks, with the world shifting more towards digital-enabled platforms and quick policy servicings, while the auditing becoming more important than ever, how can we really look at the future?
Yeah, I'm reading the question right now.
Sure.
Okay. Yeah, so I think the question is, there's different regulatory environments in different jurisdictions and different regulatory environments for different products and different lines of business and different types of property risks, right? For instance, there's going to be, differences between personal property insurance and commercial insurance. And there's going to be differences between property risk and underwriting rules in Europe, the EU, India, South Africa, Australia, the United States, and so forth, right? So ultimately, I think that to a large extent, the information that is recorded as part of the underwriting process, that what Rakesh was referring to as the audit trail, that is going to be there regardless. Okay, how you use it and what is acceptable in one jurisdiction or another is what's going to vary. But the information is always going to be there, and you can go in and extract that information and in effect see the entire decision-making tree, all of the decisions, all of the data, all of the logic that was applied in that underwriting process. Now, whether or not that logic, those decisions, those limits were appropriate for the jurisdiction is going to be driven by how that system was configured and set up. If that system was set up and configured properly for a particular jurisdiction, it will follow those rules and the audit trail will show that. Now, if you're a carrier, a multinational carrier, where you're writing in multiple jurisdictions, then obviously you're going to have to use the geographic location of the risk and the party that is going to be writing the policy, whether it's an in-country or an out-of-country carrier that is going to be carrying that risk and issuing the policy, that would all go into how that logic tree and the decision making was set up originally. So once it's configured properly, once it's set up properly, the audit information is going to be the same. It'll record everything that happened, every decision that was made, and then you take that and apply it against the rules and regulations in that jurisdiction, and that's how you end up doing that level of compliance audit.
Just like to add two more things on what John said, Addy. So, see this AI models, right? I mean, it is not one size fits all, right? So, obviously, the different zones, the different jurisdictions, the different geographies, they might need a different type of transparency. Like your let's say if you think about the straight through processing, if you think about access to all this different data, right, which we covered as a part of our the solution framework, many of those things vary as well. So the model needs to be trained, and this is what it is happening. It understand your geo nuances, it understand your nuances specific to the line of business, it's understand all the regulatory needs. And that is what it needs to be more transparent. And more importantly, when any of this AI adoption happen in any part of your value chain, that needs to be well tested. That needs to be, those model needs to be tested. The entire process needs to be tested before it goes live. Obviously, and that's the reason we highlighted that the need of making it more regulatory compliant, ESG compliant, those are no brainers. So while this everything, all these different technology component, all these different solutions can be integrated, it can be make your underwriting more efficient. But at the same time, there's a conscious decision that needs to be taken, which again be part of your the strategy of how your entire underwriting process is running right now, what are the different parameters that you need to consider, how that can become efficient, not at a cost of any compliance or any audit log penalty for sure. So these are the various things. It is not that you can just come and implement that. It is about thinking about strategize, make it more compliant, and then only you can get into the next step. Hope that answers your question, Addy. Yeah, Manjit, we have 4 minutes left. Any more questions, maybe?
Yeah, maybe we can take up one more quickly. So I have got one. How are insurers using STP to improve customers acquisition, especially in low margin or high volume segments?
Uh,
I can go ahead and take it if you don't mind, and then Rakesh, you can add
Go
up,
ahead.
and we'll
Yeah, go ahead,
we'll
John.
wrap up.
I'll add if something new.
So,
Yeah.
So the whole idea behind straight through processing is straight through processing is kind of like turning the automation knob up to 10. So there it is extremely efficient, extremely fast, right? However, that means therefore that everything in that decision-making process has to be be able to be decided in an automated fashion, right? That's what makes it a straight through process. So we're talking about policies that are, the underwriting rules are clear, the data is clear and unambiguous, the risk level is below a certain threshold, and the pricing falls within certain parameters. So what a carrier will do when they are instituting straight through processing is they will decide what those guardrails are. Right? And those guardrails will typically fall into those areas I just described earlier. So as long as a risk falls within the prescribed guardrails, then it can be processed automatically, not require review. And ultimately, I think as Rakesh showed earlier on one of the earlier slides, in certain situations, and it's not uncommon, so this isn't an outlier, you can see straight through processing once the system is up and running and the clients have become comfortable with the results of the process, you can see 25%, 35% of new business or renewals getting processed in a straight through process, not requiring any intervention. And no reduction in quality, no reduction in or no increase in risk for those policies. And what that does is that frees up the people that would have worked on that policy to focus more on other policies, other underwriting risks that might lead to increased premium. Might be able to tackle a more complex policy, get it done faster, allow you to capture that business that might have gone to a competitor.
Sure. Thank you. And with this, we'll conclude the Q&A session. Thank you again, John and Rakesh, and thanks to everyone who joined us today. We have covered a lot in just an hour, from the limits of traditional underwriting to the real-world impact of AI, CAT modeling, and live data on underwriting strategy. If your team is facing similar challenges or would like to discuss it more, we'll be happy to continue the conversation in a more focused setting post the webinar. You'll receive a recording of this session and additional resources in your inbox shortly. Until then, stay safe, stay innovative, and thank you again for being with us. Have a great day.
Thank you. Thanks.
Thank you. Thanks, Manjeet. Thanks all.